If you own rental property or you sign tax returns for people who do, you are probably wondering the same thing as everyone else right now. Did I completely miss the window on big real estate write-up? Or does this new bill actually give me a second chance? That's what this whole series is about. Cost segregation under the big beautiful tax bill that kicked in during 2025 and what that means for your 25 return and your 26 deals and the next few years of planning. I want to be really clear from the start who this is for. If you are a landlord with one duplex or a small portfolio and you always assume cost segregation was only for giant hospitals and hotels, this is for you. If you are a tax pro who keep getting questions about bonus depreciation, REV, SRT, QBI, repair rates, and you feel like you are stitching together random CPA slides, this is for you. And if you are a real estate savvy person who keeps hearing 100% bonus is back, but you're not sure how it's actually showed up on the real return, this is for you too. Let me give you a simple roadmap so you know what you are about to get yourself into. I'm going to break this trailer into three big parts so you can track where we are. So first, what actually changed with the big beautiful tax bill for cost seg and bonus depreciation. Second, what that means for a real investor and client in late 2025 heading to 2026. Third, how to use this course so you are not just learning concept, you're actually using it to make better decisions. Let's start with the first piece, what actually changed. As of mid 2025, Congress brought back 100% bonus depreciation for most property with a recovery period of 20 years or less and described it as permanent unless they decide to mess with it again. That now baked into the code for qualifying assets you play in service after the law took effect in 2025. So if you have a 5 years, 7 year or 15-year property, furniture, equipment, land improvement like paving, fencing, exterior lighting, a long list of interior build out items, the default is no longer slow drip over year. It's full deduction in year one. As long as you classify it correctly and you actually place it in service in time. What did not change is just important. Land is still not depreciable. Your basic residential building is still 27.5 year property. Your basic commercial building is still 39-year property. Cost segregation is still the same core idea. Pull the short life pieces out of the big slow bucket and move them into a faster bucket that qualify for 100% bonus. This bill didn't invent cost seg, it just makes the payoff much bigger again. What That's the first big idea. Same rule about what's 5, 7, 15, or 39, but more powerful outcome when you do the work. Now, second, what does that actually mean for you sitting here in late November 2025? I want you to think in three windows build of this release date. The next few weeks, about 6 months out, and about a year out. Right now, from late November 25 to the end of December, the question is what already happened in 25 that I can still fix on the tax return. If you bought a rental this year, or there's major improvements like parking lots, landscaping, interior build out, receipts, appliance packages, you might already have a 25 deduction hiding in there that you haven't even labeled yet. Most people are just letting their software dump everything into building 27.5 or building 39. If that what you've been doing, this series is going to show you what you are leaving on the table and how to start splitting those pieces out. About 6 months from now, roughly May 2026, you are going to be one of two situations. Either you are finalizing or even amending 25 return and asking, did we actually grab 100% bonus where we could? Or you are looking at new deals for 26 and asking which property will actually give me more first year deduction under the new rules. This is where cost sec start being once in a lifetime engineering report and start being a planning tool. You will be able to look at two properties, one with heavy site work and improvements and one that a plain box, and understand in plain numbers which one is more powerful for your tax picture under 100% bonus. Then about a year out from this, you are back in year end mode, and now with the next year tax return on the line. By that point, you have followed the series. Your year-end checklist will just be saying, did you buy or sell anything? It will say which property or project have obvious 5-year, 7-year, or 15-year pieces that qualify for 100% bonus. Do you have enough documentation, invoices, photo, work order to defend those classifications if they're ever asked? How does this tie into our exit strategy? And are we okay with the recapture when we sell or 1031? That's the second big idea of this video. We are just trying to squeeze one big deduction in 25. We are not doing that. We are building a way of thinking that carry through the 26 and beyond. Now, third, how do you get the most out of the course? So it actually moves the needle and doesn't just become more noise. The series is not going to turn you into an engineer. We're not trying to. We are going to do it to give you a clear understanding what you can handle with a planning level template or spreadsheet. What absolutely needs a formal engineer-based cost segregation study, and how to talk to your CPA, EA, or engineer so anyone is on the same page and you're not working at cross purposes. The early modules are going to stick to plain language. We'll talk about your building in terms of short life bucket and long life bucket, and we will connect those to real numbers, how much you put down, how much you finance, and what your tax bracket actually is. Midway through the series, we're laying in the other pieces that matter under the new law, repair, repair regulation, partial disposition, real estate professional status, short-term rental grouping, QBI, and how 100% bonus interact with all of that. Not theory, the practical, what happens if I do this scenario. Later in this series, we're going to go into multi-year planning. What happens if you are planning to do a 1031 after getting a big bonus hit? When it actually makes sense to slow down depreciation to keep QBI or avoid pushing yourself into a bad recapture situation later. How to think about stacking this with energy credits and other pieces inside a big beautiful tax bill instead of treating each thing in a vacuum. Here's how I want you to use this course. Starting right after you finish it, Chola, first make a simple list. Nothing fancy, just write down every property you own today, the year you bought them, the year that you purchased the property, any major improvement from 25, even if you just write new parking lot, interior rehab, appliance package, landscaping. Second, be honest with yourself about your role. If you are an investor, your job is to know which questions to raise and when to push for a cost study or a better classification, not to memorize code sections. If you are a tax pro, your job is to know when to go beyond building, plan, and align for improvement, and how to document your position so you can sleep at night. Third, as you go through each lesson, pause and apply just one idea to your own list. One lesson might be which of my 2025 projects probably has 5, 7, and 15-year pieces. Another might be if I'm thinking of selling in the next few years, do I really want to max out bonus on this property or should I be more surgical? If you do that, this will be just a more cost content. It will become your personal roadmap for using the big beautiful tax bill to your advantage instead of just reading headline about it. So if you've been feeling like you missed the window or you are worried you are leaving money on the table because you don't understand all the moving parts, stay with me. In the next lesson, we are going to strip away the jargon and talk about what cost segregation actually does for you in real life, how it changed your cash flow in the first year, how it reshaped your return over the next few years. And when people get burned, when they only look at the first year savings, grab that list of your property and your 25 projects, keep it next to you, and I will meet you in the next lesson.